Welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Investment and financial advisory fees. There are numerous articles and even books written to help investors understand the fees they pay, as well as to try to minimize them. And yet, investment-related fees continue to confuse the vast majority of Canadians. According to survey results released this summer by the Mutual Fund Dealers Association of Canada, 4 in 5 Canadian investors could not identify the fees they were paying correctly. Joining me now to discuss financial advisory fees and more is Jean-Paul Bureau. He's the Executive Director at FAIR, which stands for Canadian Foundation for Advancement of Investor Rights. It's great to have you on Strictly Money.
Thank you very much, Saijal. It's nice to be here.
So why is understanding fees still so confusing, especially because there seems to be a lot of focus on it? Is it because it's too complex? Is there not enough information? Or is there sort of a lack of will to educate oneself?
You know what? It's probably all three of those things. First and foremost, fees are by nature very complicated. There are many different types of fees. There are different fees for different types of financial products that you buy. Some fees are clear and simple to understand. You pay them directly. Other fees you pay indirectly, so you may not even be aware that you're paying them. And then there's a lot of technical language and jargon used around fees, which makes it very difficult for people like you and me to really understand what it is we're paying for.
Jean-Paul, when I run workshops or when I speak to women who are enrolled in my program, one of my key messages is that no one will care about your money or should care about your money more than you. And it's really important to educate yourself and ask those questions. But I also do feel that a lot of people have to play a role in making sure investors do understand this. Advisors play a role, regulators play a role. Do you agree, or do you, at least from your experience, think that there's one group that really does have to lead this?
Well, I think you're if you're dealing with an advisor, obviously your advisor has a responsibility to talk to you about the fees they are charging, and they should explain them in a way that you can understand them. Regulators play a big role in this as well, because they actually set the requirement for how your advisor discloses those fees in terms of statements you might receive. But ultimately, it's up to you as the investor. This is your money, and you should understand the fees that you're paying. And some of the fees may not seem all that significant, but over the long term, they can have a significant impact on your investment. So I think all three groups, if I could put it that way, share responsibility. But ultimately, I think it's up to the investor to try to understand, talk to the advisor, ask questions if you don't understand what fees you're paying, and don't take a vague response as an answer. Really try to understand the fees. One way of thinking about it is, for every dollar you save on fees, you're in fact giving yourself a bit of an investment boost. So it's well worth your time.
Do you think detailed reporting would help? You mentioned that some of the fees are transparent, some are not as transparent. And I ask that question because sometimes investors say, you know what, yes, it would help. I want all the details. But then again, it becomes overwhelming as well. So do you think that's the answer, or even perhaps, a signed acknowledgement from the client that they actually understand the fee structure?
I do think, and I think you raise a very good point, that there's a tendency to want to get all the information. But we all know we can be fairly easily overwhelmed when we get too much information, especially when it's very technical or jargon-filled kind of information. It's very hard for us to wade through it. Having said that, right now, one of the issues is that investors are not getting a complete picture of all the fees they're paying. So we have to find a way to make sure that you, as an investor, do see the complete picture. The challenge is, how do you present that information in a way that is understandable and that you can actually use in terms of your future investment decisions.
Okay.
And
I'm going to cut you off there because we're going to take a quick commercial break because I think you make a valid point, and we're going to come back and look at those fees. We'll be right back. I'm here with Jean-Paul Bureau of FAIR. Jean-Paul, I want to use this segment of the interview to run through the different fees and get your take on some of them. Let's start with MERs, management expense ratios. There are 4 components. We have a board that's going to come up. Typically, these fees run around 2%. Sometimes they're higher, sometimes they're lower. Let's talk about the overall, the MER fees.
Yeah, so let me first, I think it's important to give some context. MERs are a specific type of fee that when you buy a mutual fund, for example, you will be paying this fee. What's important to remember about MERs, which stands for management expense ratio, are a couple things. One is you pay them indirectly. They don't come out of your account, they come out of your investment funds. The second thing to remember is they're paid not in a dollar amount, but as a percentage. And so what you're basically paying for is if you own a mutual fund, for example, somebody has to manage the fund, and they obviously incur costs. Some of that relate to the administration of the fund. Some of it is to manage the picking of the portfolio that's in the fund. There's legal fees, accounting fees, administrative fees, all kinds of fees that are associated with operating a mutual fund. And all of that goes to the manager of the fund. And like I said, it's usually expressed in terms of a ratio. So it might be 1 to 3%. And what that means is if the fund has like $10 million in it, and the MER is about 2%, the fund manager will be taking $200,000 in fees. And that is ultimately money that's coming to your pocket.
Yeah. What about trailer fees? I want to get your thoughts on this one because this is a controversial one, right? This is money that goes to your investment dealer or advisor, supposedly for investment advice.
Yeah. So trailing commissions are a component of the MER, and they range from about a 0.25 percentage point to 1%. And what it is, it's the fund manager who takes money out of the fund and pays the different people that have sold you that fund. And the purpose of trailing commissions is to pay for ongoing advice and services that individual is supposed to be providing you. And again, it can add up quite significantly over time. One way to think about MERs and trailing commissions, and you might think 1% is not all that significant, but if you think about your mortgage, and you think about the difference between paying a 3% rate on your mortgage versus a 2% rate, I think most people would understand that's a significant difference that can really add up over time. Well, the same principle applies when it comes to MERs and trailing commissions.
And I don't think, Jean-Paul, people argue that they shouldn't pay for, professional management and advice as long as you're getting it. I thought what was very interesting, because you and I had a quick conversation before this interview, was the self-directed ones. And they also have these trailing fees, which actually doesn't make sense, does it?
Right. It doesn't make any sense. And in fact, again, the purpose of the trailing fee is for the fund who's paying your advisor to give you ongoing advice. When you have a self-directed account, you're taking full control of your investment decisions. You are not getting advice. So in those situations, when you do buy a mutual fund that has a trailing commission, why should the firm that you're dealing with, that you have your self-directed account have, why should they be getting 1%? They're not providing you with any advice. And this has been a big problem in Canada. And a lot of investors have lost money as a result. And the regulators finally took action Bit of good news is that effective next summer, June 1st, these types of trailing commissions, when you are buying through a self-directed account, will be banned.
Okay, so that is coming. That change is coming in June, you said, or in the
It
summer?
will take effect on June 1st,
Okay.
2022. We would encourage people, though, in the meantime, not to just wait for it, but to talk to the firm and ask the firm to stop collecting that trailing commission, because they're getting paid for a service they are not providing you.
Interesting thought. Okay, we're going to take a quick break. We'll be right back. I'm here with Jean-Paul Barreau of FAIR. Jean-Paul, before the break, we were talking about different types of fees. I want to go back to, because there's the management fees and then there's the sales fees, the fees that you actually pay to buy or sell a fund or even switch between the fund. Deferred sales charge, this has been quite controversial, and it looks like they're finally doing away with them.
That's right. So effective June 1st, 2022, all mutual funds with a deferred sales charge structure will be banned in Canada. And this is good news for investors. Basically, what DSCs are is when you buy a mutual fund, in some circumstances, you would actually pay a fee upfront. And so if I had $1,000 in my pocket, I want to buy $1,000 worth of mutual fund, I might actually only be able to buy $950 worth of mutual fund, because the other $50 or 5% goes to pay that upfront commission. Deferred sales charges basically defer that. So you don't pay anything upfront in terms of a fee, and the trick, though, or the problem, is that there's usually a structure behind it that says that if you sell that mutual fund in a year, you'll pay the 5%. Or if you sell it after year 2, you might pay 4%, and it'll go down. The problem is it creates, there's a couple of problems. One of it is a lot of people will buy that DSC product because they feel they're doing better because they're not paying a fee. They don't feel like money's not coming out of their pocket up front. The problem is, at some point, and probably within the 5 to 7 year period, you may want to sell that fund. And what happens is that people, even if the fund is performing poorly, they defer selling it because they don't want to pay the fee. So it actually has a very poor results and bad impact on investors.
And can you clarify, though, Jean-Paul, if you switch funds within that fund family, are you also penalized? Does the deferred sales charge, well, I guess this is past tense because it's going away, but would you have been charged?
There can be switching fees, and there, like I said at the beginning, there are many different types of fees. There are early redemption fees, there's switching fees and things like that. So you have to be very careful. Probably the most important thing, though, is to be on the lookout for any kind of mutual fund product that you buy that has a deferred sales charge structure to it, and ask that you not be put into that kind of product. And if you currently do have a product, and this became a very big problem during the pandemic, when people needed to tap into their savings, and then they got a wake-up call because they realized they were going to have to pay all these deferred fees, you can speak to your advisor or the firm and ask them to waive that fee. And often they will. Okay. And so I would encourage people to look at their statements, see what kind of product they have, and see if they can get those fees waived.
Yeah, that's a really good point. One of the challenges I think that I see, and this is more, I guess, from a behavioral or motivational point of view, is that, and I have this conversation with a lot of investors, they say, you know what, I don't, who cares about the 2% MER? As long as my portfolio manager is making me money, it's okay.
Well, there's two problems with that. One is, for example, if the fund you've invested in, let's say, had a good year and the value of that fund increased by 6%. You're actually not going to get 6% return on your dollar, because the manager of that fund is going to take their whatever it is. If it's a 2 or 3% MER, they're going to take that out of the fund. So you're left with the difference. So if you have a situation with a 2% MER and the fund appreciated by 6%, your rate of return is only 4%. And so that's pretty significant. The other thing that's really important to remember is that these percentages add up and exponentially over time. So if we try to take a simple example where you invest, let's say $50,000 in Fund A for 20 years, you don't touch it, and that fund grows every year by about 5%. And your neighbor makes the same, but invests in Fund B, and they're paying 1% MER, and you're paying 2% MER.
Yeah.
At the end of that period, you will have paid more than $20,000 in fees than your neighbor.
Welcome back to Strictly Money. I'm here with Jean-Paul Barreau of FAIR. Jean-Paul, I want to get your thoughts on this because, we do focus a lot on fees. And yet, I think what it really does come down to is it's about value, isn't it? It's about, what are you getting? We're not saying that fees are all bad because there's a cost to doing it yourself. There's a cost to not doing anything or making a mistake. It does really come down to the value that you're getting for those fees, does it not?
It does. Listen, I think there's going to be a fee involved in fees in everything you do in life. So fees are not inherently bad. The issue here is it's difficult to know all the fees you're paying, and therefore it's very hard for you to assess whether you feel you're getting value for what you're paying. And that's basically the fundamental problem.
Okay.
So some people are more than happy with the fees they're currently paying. Other people may be less happy with because they don't think they're getting the advice or the services they're paying for.
So what trends are you seeing right now in terms of pushing for investor rights? Or what is it that you believe the industry needs to focus on right now?
Well, a lot more work has to be done in terms of how you present fee information to investors. And I think the fundamental problem is those in the industry and the regulators, when they use these very technical terms, it's clear what they mean, but the rest of us don't.
Yeah.
So they have to start by putting this in very plain language. They have to try to put it in a way that makes it more meaningful for us as the client. So I don't know about you, but I get a lot of different statements, bank statements, Visa statements, and there's a lot of language in there that, frankly, I don't really understand. So some of it is trying to find a way to put this in plain language, explain it in simple terms, so that people can really appreciate what they're paying, and then they can make their own decision as to whether they're getting value for what they're paying.
The MDFA, they did list a number of recommendations with this report, and one of their suggestions was linking fees to investor choices. So saying things like, you are paying this because you made X, Y, Z choice. Do you think that's a positive move?
I think it's critical, actually, because I think people don't understand, and we talked about MERs. So people may buy a mutual fund that has a high MER rate. Those fees are taken out by the time you get your statement. You've already paid them. So you may not appreciate that you can actually change that going forward. And the easy way to do that is to change the fund and find one that has a lower MER. And you can save yourself fees that way. But people don't see that connection. They don't appreciate that the reason that fee is 2% is because the choice they made a year ago.
For those, I was going to say, for those investors that are watching the show and will watch this show, how should they use their voice and energy to make or to advocate for changes? And maybe another question is, how easy is it?
Well, I think you have to speak up. So you can start. The first place I would start would be to talk to the firm or the advisor that I'm dealing with,
Okay.
and ask them questions. It is your money after all. You
Mhm.
have every right to know what you're paying in fees. You can also talk to regulators. I think right now the regulators are quite focused on this issue, and I think it would be good, and I think they'd be very receptive to hearing from people, everyday Canadians, in terms of their views and thoughts on fees and how to improve the disclosure. They are currently working on a project called the Total Cost Reporting Project.
Okay.
And I anticipate, although they haven't established any deadlines yet, but I anticipate they'll be publishing a proposal for comment. So it'd be great for people to look into that and see if they want to provide comments to the regulators on how they can improve the reporting.
All right. Jean-Paul, it was wonderful having you on the show. Thanks so much. We'll have to have you back.
Thank you very much. I was glad to be here.
That was Jean-Paul Barreau of FAIR. Well, those were great insights from Jean-Paul Barreau. And you saw that he even said that when he gets contracts, sometimes he doesn't understand them. I don't often understand what I get. So it is okay to ask questions of your firm and your advisors. Speaking of which, if you have questions, please send me an email. Until then, stay well, stay wise, and stay wealthy. Thanks for watching.